Welcome to another great video. We're talking, can you make interest of a mortgage tax deductible? I know you can do it in the US with your home, not so much in Canada, but there are a couple of ways you can get tax deductible interest on your mortgage. And that's what we're going to cover today, Kevin. So let's jump right in with the key concept to really make interest tax deductible. Well, it all depends on what you're borrowing for, right?
That's right. Yeah, borrowing to invest is the biggest one. So, I mean, if you basically took out a loan at the bank and you put that money right into a non-registered account and put that non-registered account money into an investment, now that interest that you're paying on that borrowed money is automatically tax deductible. That's the biggest thing to know about borrowing to invest. Now, how to do that on the mortgage scenario is a completely different thing because, as you mentioned, the U.S. allows that, but in Canada, if you actually go get a physical mortgage for the home, now that interest is not tax deductible.
Your home's not an investment, apparently.
That's right. So yeah, we all know it really is, but that's not the scenario to do. Now, there are a variety of ways that we can probably try and do some of this. One of them, though, is basically known as the Smith maneuver, Clint. And what is the Smith maneuver?
Yeah, well, this is named after Fraser Smith, who was a BC financial planner. That's how I knew you made it in life, Kevin. We have something named after you. So before you retire, I want the Becker maneuver, whatever that's going to be.
I'll find it. I will get it done.
But the Smith maneuver, the idea is, well, how do you get interest on your home from that mortgage to become tax deductible? I'll explain it with a couple of scenarios here. The first scenario, you're looking at, all right, I'm buying a house. The house costs $450,000. It's an example. Let's assume somehow you saved up 150 grand of a down payment, and then the rest, 300,000, will be a mortgage. And then on the side, you've got other investments. Scenario one, you put the down payment, you get a mortgage, you buy the house, you leave the investments exactly as they are. That would probably be the most common scenario. In that case, the mortgage, not tax deductible. You're borrowing for your home, your principal residence in Canada. You don't get any tax deduction on your mortgage for that. Scenario two here, slight adjustment, Kevin. In this example, you're assuming instead of just leaving the investments alone, let's say you cash them in.
That's right.
300 grand from your non-registered account. You used your down payment you'd saved up plus your investments to buy the house. And then now you have a property, you take a mortgage out on the property and use the mortgage to replenish your investments. So technically you're borrowing against your house to invest, which is different than scenario one. And in scenario two, now you're borrowing to invest and the interest on the mortgage becomes tax deductible. So lots of nuances here when you dig into it, but high level, you go from borrowing to buy a house you live in to using your investments to buy the house and then borrowing to replenish your investments. So now in scenario two, you're borrowing to invest and you get the tax deductible interest. Does that make sense?
Yeah, it does. I mean, that's a perfect example of how you can go about getting into that sort of tax deduction method for what the mortgage really is. But again, no matter how we want to do this, there's always a trade-off one way or the other. And that's the biggest question in scenario two is that even though, we have a large amount of non-registered money going into the investment, getting that non-registered money into cash, well, maybe you're selling a whole bunch of investments. You're realizing capital gains. You're giving up distributions or anything else over that period of time before you can replenish those. So that may cause other tax consequences down the road. So again, it's not all just, we can take one side and put it right to the other. There are consequences that will happen in the middle to be able to do it. So you must realize those ones as well before deciding that, hey, this is a great idea. Let's just do it. Now, in some cases, it'll work out really well. In others, maybe those gains are something, maybe more tax than what you're going to be paying if you left the mortgage as scenario one.
Yeah.
But that's not the only scenario we've got, is
it? Yeah, we have a scenario three here, but just to recap, because that is a very important point you just mentioned, there's kind of two catches there, if you want to think of them as catches. One is, it assumes you've got a big chunk of investments just sitting there.
That's correct.
Not investments in an RSP, because that'd be far more tax, but just investments in a non-registered account sitting there that you can use to buy the house. I get that's not everyone, so it's a small number of folks would be in that category. And the number two, like you just talked about, selling all those investments to use the cash to buy the house could create some complications of their own. But scenario three here, a little different, kind of maybe more realistic for folks. You buy the house, Kevin, so same idea. It's not tax deductible, but then as you pay down that mortgage, so let's say you had $200,000. This is a new example, $200,000 of a mortgage. And after a number of years, your mortgage only $175,000 outstanding. Well, you can now borrow that equity you built up. So in our example, you can borrow 25 grand. That can go into an investment. You now still have 200 grand of debt, but you have 25,000 of investment and you've got a tax deduction there on the interest for the portion that you're borrowing to invest. So as you pay down your house, you're kind of building your investment and creating that tax deduction as you go. So instead of having the cash just sitting there, well, as you pay down the mortgage, you're creating that non-registered account, borrowing against the equity you're creating in the home when you pay down the mortgage. So it probably a little more realistic in the ways to make it into a tax deductible scenario. Always trade-offs, like you said. One of the big one here with the Smith maneuver, specifically scenario 3 of this Smith maneuver, Kevin, is risk.
Yeah, and that's the basic one that you really have to take a look at is no matter what happens, I mean, it seems like everything else. If you want to get a good tax break, you're going to have to give up something on the other side. And again, the way they've always phrased it, if you're going for dividend or capital gain, you got more risk involved, but you get a better tax scenario. Here, it's the same sort of thing. You have to be comfortable being leveraged. So, a lot of people want to just pay that mortgage down. You have 200,000, next you have 150, 150. It's great. No more debt. Here, you're still maintaining that 200,000. You're just getting that tax deductibility. You are getting non-registered investments, but there is a risk with the leverage play. Interest rates increase. You start paying more in those sort of scenarios. So you have to be comfortable with the risk that you're going to take if you're using maneuver 3. Again, that risk and leverage is the biggest factor that may be a big play as to, do I want to do this? Do I not? Some people, depending on your age category, not a problem. Maybe in the later years before retirement, may not be as comfortable wanting to hold that much debt going into those sort of scenarios.
Yeah, and we're living through the risk now, right? Rates jumped significantly in the last 18 months. Imagine if you had borrowed money to invest and then suddenly the rate of debt or the rate of interest on that debt jumped. I mean, it changes the mathematics quite a bit. So you have to be comfortable with the risk for scenario 3. It's not for everyone. And this is also key. Where we mentioned non-registered investments a number of times, and that's for a reason, is because if you borrow money to invest in an RSP or a TFSA or an FHSA, really any acronym in the financial world, you borrow money to invest in that, you won't get tax deductible interest. The idea here, I think, is that those accounts have their own tax perks associated with them. So you can't double dip. You can't borrow money to put in a tax advantaged account and get the interest tax deductible. So you borrow money for a non-registered account, which is not in that category, well, then you can deduct the interest on the fund. So that's also another important note there, is the type of account you're using for this investment is not the RSP, TFSA, FHSA, whatever you have. It's actually a non-registered investment account.
Yeah, the government will only give you so many chances to dip at the trough before they're going to start taking the money away.
Yeah, and we'll go through a couple here. That was a big one, the Smith maneuver, and we went through a few scenarios there. A second way you can make mortgage tax deductible, I think this is more straightforward, Kevin, is you get a rental property.
That's exactly, basically, if you're buying a property to rent it out, you are making an investment. That is a big factor going forward. This is not your principal residence. You're not buying an additional cabin strictly for you and the family. Now, if you bought the cabin strictly to rent it out for everybody else and never use it, now all of a sudden it becomes an investment, and the government is going to say, that's fine. If you put the money into this property specifically so you could rent it out, now you have deductibility on that tax when you take that mortgage out. And that's the biggest factor, whether it's a cabin, whether it's another home, whether you're buying an apartment block, whatever the case may be, as long as it's not your principal residence and you're using it for generating income of some format, now that rental property becomes a tax deductible expense off the mortgage.
Yeah, and a version of that, one that might kind of fit in with people's lives, is let's say you use the cottage, but not all the time. So you rent it out while you're not there. Or perhaps you have an extra room. Your kids moved out, so you got a free room. You rent out that room. You go on Airbnb, you rent it out. You could claim some tax deduction expenses if you're renting out a room or renting out a second property that you're not using. It essentially comes down to proportional. If you have 25% of your property, and I'll bring up an example here. Let's say you had a house, the room equates to 25% of the property. Well, 25% of the related expenses, in this case, the mortgage interest, would become tax deductible. So you are able to do that. If you're renting out the cottage when you're not using it, renting out a room in your house, you'd better get to claim the related expenses. You also get to deduct any interest on the mortgage proportionally for that property. So it's another way you can make the interest on your mortgage tax deductible. We got one more option that we're going to go through before we do. We get questions like this all the time. Where should people go if they have a similar question?
they should go to chatwithclintonandkevin.com. We are more than happy to answer any of the questions you have on this mortgage-related interest scenario that we're talking about today, or any of your financial planning questions or investment questions. If you just want to know something, send us a quick link and we'll get back to you as quickly as we can. We want to be able to make sure that we can help out and address every question that you have going forward, just so that you're there and you know that we have that financial ability to be able to do that. But yeah, now we can get to that sort of final scenario. We've already done the rented out a room or renting out the cabin for a space. But again, the other factor comes with home-based businesses. Now, if you run your business out of your home, you can claim a certain area for where you're dealing with that. So if 25% of your home is used strictly for your business, then that becomes a tax-deductible expense because it's a business expense. So now the mortgage on that portion, that designated space of the area of your house that is for business, is now tax-deductible off that mortgage because it is used for that one purpose. It's not claimed as part of your principal residence as it would be if you weren't using it that way.
Exactly. And again, you already mentioned it, proportional, right? If you have a percentage of your house, hey, this is now a business, I'm claiming the expenses for business. Well, now you're borrowing to invest in a business as it relates to the mortgage. Now you can deduct that portion of interest for the business. But again, no magic solutions here, Kevin, only trade-offs, no magic solutions. And of course, there's going to be a catch here. We talked about it when we talked about the Smith maneuver. If you rent out a room in your house or rent out the cottage when you're not using it, or perhaps you have a home-based business, the big one that comes up is the principal residence exemption.
Yeah, basically, if you're going to be using portion of your home or your cottage or whatever the case may be for rental or for business, well, all of a sudden now that's not your principal residence anymore. You've already taken the deduction for the interest on that. When you sell the home now, that 25% of the home is now capital gain oriented because it is not considered part of your principal residence. You utilize this for something else. And as a result, the government's going to say, look, we're not going to give you the benefit of both. You're either using it as a business or using it as your principal residence, so you can't have the deduction both ways. So they're going to say 75% of the home, fine, we're not going to worry about it, but you now owe capital gains taxes if it's gone up as a gain for that extra 25% on the home, or use that from the cottage. So that's the biggest one to remember. And again, there's always a trade-off. They're not going to give you both.
Rarely does that happen. There's rarely a magic solution. And when you have these kind of trade-offs, of course, when it comes to taxes, talk to your accountant. They're going to know your tax situation. They're going to be able to help out with the nitty-gritty details here because we cover this at a high level. You're going to want their expertise when it comes down to exactly how it applies in your specific situation. I think that leads to the Becker Orr mantra here, Kevin.
Yes.
Whenever it comes to items like this, especially if there's trade-offs, it has to fit with your plan. That's the overall idea there. Is it has to be a fit. It has to work with your overall plan. We rambled for a while there, went through a couple of options when it came to how to make interest tax deductible. There's probably a video floating. I think it's over here. Maybe it's over Kevin. I'm not sure. Either way, it's going to be about the principal residence exemption. You want to click on that one, and we'll see you there very soon. Take care.
Take care.